Mark, I wanted to talk with you a bit more about a more serious subject today, the current crude oil situation in the global markets. Now, this has been a running theme in our podcasts. Our last podcast was also focused on the crude pricing. And following that podcast, for the first time ever, we saw the near month May WTI contract trade in the negative, closing at negative $37 a barrel last Monday night. In my 15 years of working in trading, Mark, I don't think I've ever seen a physical commodity trade in the negative. So in essence, crude sellers were paying buyers to take their stock. It was quite remarkable.
Amazing. Just when we thought volatility couldn't get any more intense. So it was a real moment of history and an event that will no doubt be referenced in generations ahead. We've seen price wars before and that battle for market share. But the timing of recent events during this current pandemic, it's really created a truly unique situation. So as you said, last Monday, during very thin liquidity ahead of Tuesday's expiry, we witnessed the price of WTI May plummet past zero and into negative territory. So that negative value indicates that the holders of May contracts were effectively willing to pay to get out of their positions. So ultimately, that was to avoid receiving physical delivery next month. So why has this happened? The supply surplus has led to essentially a shortage in available storage. So it's something to be very mindful of. We saw OPEC Plus reach an agreement early this month, but whilst supply is shrinking somewhat, it's nowhere near enough to mitigate this dramatic slump in demand. Transport accounts for approximately 60% of global oil demand, and with nearly 3.6 billion people under strict lockdown restrictions, this price slump is inevitable. To an extent, the world is really come to a standstill. Roads are empty, flights are grounded, factories are dark, so it's a very bleak outlook on demand at present.
Absolutely, Mark, and you raised one very, very key point of delivery that I wanted to touch base on. So we do know that spot crude prices, these are the prices of crude oil that we would see for immediate delivery, similar to how you'd be paying for crude oil when you're filling up your car at the gas tank. But these spot prices are actually derived from the underlying futures market, or in this case, the Chicago Mercantile Exchange West Texas Intermediary Contract. Now, I know that sounds like a mouthful, but it's the CME's WTI contract in short. And this contract is available every month in the upcoming future. So if you were to go to the CME website, you could easily find the price of crude oil for December 2020, for example, or even March 2021, for example. You could even find prices for crude, how they would be priced for 2022 or 2023 and onwards. So these contracts are all traded in this way until they expire. This expiry happens once a month, at which point the buyers take physical delivery and the sellers give the physical delivery as per the terms of the contract, or speculators roll over to the next month. So they close their current month positions and open in the next month. So what happened last Monday, Mark, as you've pointed out, was that when this contract was going into expiry on Tuesday, speculators who were trading the contract for financial gains, they didn't actually want the crude, and they were fire selling at any point to avoid that physical delivery, which in the US, by the way, is a binding contract. If you are stuck in a contract, you have to take delivery of it by law. To make the situation worse, because of the supply glut, as a result of the ongoing crude market problems, excess pumping over the past few months, resources and sites to store the crude are not so readily available anymore, as they are all occupied. So Cushing, Oklahoma, where all of CME's crude stock is stored, is operating at above 70% occupancy, for example. So it becomes very expensive to store crude, even more expensive than the price of crude itself. So all these factors came together and exasperated to see crude closing at that negative $37 on Monday. But does this mean that the value of crude is less than zero? Absolutely not. If you look at those 4-month contracts I was talking about earlier, they're still trading at healthy premiums. However, we could be in a similar situation when the June contract settles on 19th of May. We could be in a similar situation, although I don't think it'll be as ferocious as what we saw last Monday, Mark.